Hey everyone, welcome back to the channel. A couple of months ago, we took a deep dive into SentinelOne and its business model. Now, if you haven't checked that video out, I'll drop a link in the description and also over here. You can check it out. It's a must watch before diving into this one. Now, SentinelOne just reported their Q2 earnings, and there's a lot to talk about. Revenue growth, customer expansion, profitability improvements, and some exciting new initiatives that could really shape their growth story. So in today's video, we'll break down all the numbers, charts, and what it could mean for the stock. And of course, stick around till the end because I want to hear your thoughts in the comments. You know I read every single one. So let's start with the big headline, revenue. They reported $242 million of revenue, up 22% year over year, even up from last quarter's $225 million. That's quarter over quarter growth, which is huge. It means growth isn't just a one-time thing. And then there is the ARR, or the annual recurring revenue, which just crossed $1 billion. And that is up 24% from last year. Now, this means that there is predictable recurring revenue, which makes software companies attractive for investors. And here's a highlight. Enterprise clients paying over $100,000 annually grew to 1,513, up 23%. That's big because it shows that large companies are betting long term on SentinelOne. Now, looking at the cost of revenue, it went up by about 20% to about $60 million. This gives us a gross profit of about $181 million, which translates to about 75% GAAP gross margins, slightly higher than the GAAP gross margins last year. Looking at the operational expenses, the R&D expenses went up from 63 million to 79 million, which is almost a 25% increase. Now, cybersecurity is a competitive space, and while they need to invest in R&D to stay competitive, this increase is slightly higher than I would personally like. So while this quarter it seems okay, it is in line with revenue growth, you may want to keep an eye on this figure going forward. If it starts to grow higher than the percentage of revenue growth, then that's a big red flag. Sales and marketing expenses also went up slightly by about 8.5%, which is reasonable. General and admin costs went up by about 15%, including a restructuring charge of about $3.9 million. Now, this is a lever that they can definitely optimize to lower their operating costs in the future. So it looks like the CFO is paying attention and has started pulling on that lever. So that brings the total operating expenses to about 262 million, which is about a 15% increase from last year. So bottom line is GAAP net loss of $72 million, which translates to about negative 22 cents per share. But adjusted numbers show a small profit. It's about 4 cents. They're investing for growth, but costs are being monitored for now. Looking at the balance sheet looks strong. There is cash and equivalent of about 278 million, which is up from about 186 million last year. And no major debt, so the financials are solid. Looking at the statement of cash flows, we start with a net loss of 280 million, add back depreciation and amortization, non-cash costs, stock-based compensation, working capital changes, and we get to cash flow from operations of 51 million, about 16% higher than last year. Now, under the cash flow from investing activities, you'll see a capitalization charge of about 12 million. This means that the costs of developing or acquiring software for internal company use, think of accounting systems, customer management platforms, and automation tools. With a capitalization charge of 12 million, the free cash flows come out to be about 39 million, which indicates about a 16% free cash flow margins. Now, while this is a big improvement over last year, it is still lower than the previous quarter, when it clocked around 23%. Under cash flow from financing activities, you'll also see that the management is smartly buying back $52 million worth of stock. Now, that's a strong signal that the management believes their shares are undervalued. Now, the stock price has been lower over the past couple of quarters, so it makes sense for them to be buying back the stock at the lower prices. Overall, they added about $88 million in cash this period, and they ended up with cash, cash equivalent, and restricted cash at the end of the period at about $281 million. SentinelOne has recently launched two key initiatives that could reshape its growth story: SentinelOne Flex and the acquisition of Prompt Security. SentinelOne Flex is a flexible licensing model that lets customers pick and choose the security feature they need, scaling up or down as the business grows. So instead of being locked into rigid plans, companies can start small and add more coverage over time. This makes it easier for businesses to adopt SentinelOne solutions and stay long term, increasing the company's recurring revenues. The acquisition of Prompt Security brings advanced AI powered tools for data loss prevention. Now, this technology helps businesses automatically detect and stop sensitive data from being leaked or stolen. Adding this capability to SentinelOne's platform makes it more complete security solution, especially for companies in finance, healthcare, and other industries where protecting data is critical. Together, these moves matter because they make SentinelOne more attractive to customers and create opportunities to sell more services to the same clients. The flexible pricing model encourages adoption, while the AI based data protection adds value that competitors may not be able to offer. Over time, these initiatives could boost revenue, increase customer loyalty, and position SentinelOne as a leading innovative player in the cybersecurity market. Now, looking at the stock chart, I'm on a monthly chart here. For the past 2.5 years, the stock has been range bound between, say, $14.5, $15 on the low side to about $28 on the high side. So, for people who want to trade the stock, it's not a bad idea to buy it in the $14.5, $15 range and try and sell it at about $28 range. However, from a long-term perspective, considering SentinelOne's size, this could be a good acquisition target for bigger players. And if that were to happen, I believe the stock price could top out at about 28, which gives us about a 50 to 100% upside depending on your average buy price. However, if it continues to remain independent, publicly traded company, and the fundamentals continue to improve on the trajectory that they have been, there is a potential for this stock to go much higher. That said, this is not the kind of stock that is a buy and forget or making it a big part of your portfolio. Personally, I have it as less than 5% of my overall portfolio. If the growth continues in the right direction and they are able to maintain a cost discipline, and at the same time free cash flows improve or continue to improve, they are in the long term they are trying to aim for that 30% mark. If that happens, then this stock has the potential to generate multiple returns. So let's see how the revenue growth and the free cash flow growth pans out over the next few quarters. Now I want to hear from you. What stood out the most in this quarter? Revenue, AI tools, or cash flow? Drop it in the comments. I read and respond to every single one. Also, if you haven't checked out my first SentinelOne video, then do watch it. It dives into the business model, the strategy, and the long-term story. I'll drop a link in the description and also over here. And if you want to understand the playbook behind Palantir's rise, how it delivered a 30x gain in just 2 years, and what lessons we can apply to potentially spot that next 10x stock, I've got a full case study video on that. Again, I'll leave a link in the description below and right here on the screen. If you found this video useful, smash that like button, subscribe, and turn on the notifications. I've got more earnings breakdowns and stock case studies coming soon. So until then, stay data driven and stay curious.